Thank you. Thank you very much. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Thank you, class, summer school class. Today, I will be discussing or presenting the topic of disclosures and actually more on the financial reporting or the disclosure that we know, and also related to some issues. And hopefully, after we discuss about disclosure, we can then see how it actually can be related to corporate governance. But I will be focusing more on how the reporting is actually being made by the preparers, and also looking at how the users is also what are their suggestions, related to the disclosure now going on. And because in this summer school class, I think I have 3 sessions, so so this is like more of the introduction for the disclosure, and then after that, I will be related to specific to the sustainability reporting, and then at the end fraud, and maybe at the fraud, I will connect it to the how it relates to also to the corporate governance. Okay, let me share my screen for my PowerPoint. Can I do that? Okay, can you wait? Okay, can you see my slide?
Yes, Miss.
Okay, should I slideshow, or is it okay like this? Because sometimes I do have a problems with my laptop if I do a full screen show. So can everyone see it clearly, or should I make it slideshow? Is it okay with this?
Yes, Miss.
Okay. So so at this time, or at this kesempatan ya, kesempatan hari ini today, I would talk more about disclosure and why it is very important for the process of financial reporting, because having a full disclosure, this actually will help users to understand more on looking at the numbers at the financial statements. And the full disclosure is also hoping will give more quality information so that the users will have enough information for them to make judgment or to influence their judgment for making decision making. And at this point, it is important that the reader or the user are informed well. That's why disclosure become very important to be a part or to be helping the numbers in the financial statements to be more useful information. And at this point, there is a financial disasters when company are actually difficult in implementing the full disclosure. Why? Because at some point, regulators like IASB, where the IFRS are requiring a lot of standards being explained in the disclosure. And when the preparers or when management or company needs to uh, needs to do or needs to disclose all the information based on the standards that they need to make, sometimes it will become very overload, yeah, overload information, and that's also impact on the cost of the company in preparing such amount of disclosure. So this become an issue for companies where if they cannot disclose properly, or they need to implement the disclosure, it's become very hard for the company point, for the preparers point. But on the other hand, users or reader or investor, creditors, they need that information. They need full information. They need well information, because what they usually say that companies sometimes make poor communication, yeah, poor communication to the users. So it it actually affect on asymmetric information. So the information is not balanced between the preparers, between from the company point to the readers or the users. So in here, we can see from full disclosure principle. So this material is I've taken it from the KISO wagon from the intermediate accounting, when we can see how the full disclosure principle are divided into the main information or the basic financial statements. You can see here the disclosure or the basic information that company needs to give to the user are the financial statements itself. So the statement of financial position, the income statement, the statement of cash flow, and the statement of changes in equity. And related to that, company needs also to make the notes to the financial statements. So notes to the financial statement is a disclosure part of basic. Yeah, basic mean the minimum requirement that the company has to give to the users, to the readers, to the investor, to the creditors. So in the notes, it has to be related to all the numbers in the financial statements, like the accounting policies that they use, the contingencies related to the liabilities, inventory methods, that there is so many there's so many choices, alternatives from the standards that company can choose, and that's will actually also help the readers if there's notes on the number of the inventory. So because reader or users need to compare, yeah, they need to make a comparison between other companies within the industry, compare between years. So it is very important if these notes, it's also explaining, yeah, and other important thing, when the disclosure or the notes, it has to be relevant information. And that also become a complaint from the reader's point of view. Sometimes company are giving irrelevant information. They give too much not useful information, where this is very important for the company to actually understand or how they can make a good quality information. And for like the number of shares outstanding, alternative measures like fair values of items that it carried at historical cost. So there's a lot of going on with the not just the numbers, from the financial statement itself can actually give information, but the notes become very important. And this can be also based on some research. It is proven, yeah, it is proven that these disclosure are significantly affecting the share price, yeah, the share price or the firm value, where the investors are actually reacting, yeah, reacting to the information that are given to them. So disclosure become very important for the users in understanding the performance or the financial performance of a company. And then you can see here, this is an area that is affected by existing IASB rules. So this is more when IFRS or standard setters are updating their rules, and company needs to comply in that rules. So they need a supplementary information. Supplementary information. For example, there is changing prices and related to oil and gas reserves. Um, and there's some issues in leasing. I think there now has a new IFRS lately. Yeah, lately they have the IFRS related to leasing, and then there's pensions. There's a lot of updating in the standards by standard setters, and that needs to be also be um, giving a place for the company to actually explain, yeah, in a supplementary information. And then the financial reporting. So this is the financial reporting. You can see here, this is other means of financial reporting, meaning there's other tools for making the financial information become more useful, become more relevant at this point, with management commentary, letters to shareholders, and there's like auditor's report, and there is a lot of information that is sometimes give more influence, yeah, in the readers to make judgment or decision making for this company. And other information, so this is more like all information useful for information, investment, credit, and similar decisions. So other information also become very important when in here related to the competitors, the competitions, analyst reports, economic statistics, and articles about companies that actually also helps investors or creditors to make their decision making. So there is a issue, however, in the increase in reporting requirements. So there is become a very massive effort, yeah, a massive information or a huge effort for a company to do a reporting. And there are some certain situation when the company has to recruit 50% of more accounting people or content for helping them to actually generate the disclosure or the reporting. And the reasons behind this is because the complexity of the business environment, and that impacted on more and more standards they need to comply, information they need to put it in their financial reporting, And this also become a necessity for timely information. For instance, usually they have a very full disclosure for the annual report, but now because they want a timely information, the interim report, so the interim report, the half year report, or even the quarterly report, they wanted a very full information. The users wants information that is update current, so it becomes also hard for the company to make this requirement or to be able to comply. But uh, one thing that we need to also note that uh, between compliance and good communication, sometimes when company wants to comply with all the standards, they do a lot huge of disclosure, but at some point it become not a good communication, uh, because sometimes we want a straightforward communication, we want a good quality communication between the preparers and the users. So that become also an issues when we look at how disclosure are becoming very important. And then full disclosure is also now counting as a control and monitoring device. And this is a very important because disclosure gives better information, yeah, give better view for the outsider, for the external people related to what's going on internally, what's going on internally in a company related to their financial performance. So this is the underlying concept. So there is the IASB actually make a surveys. Yeah, they hand out a surveys to the users and the preparers, and they want to make sure that they get a better information rather than more information. So they need better quality information rather than not useful information with so many information that they receive. So in here, the survey is there is to meet the users' changing needs and business reporting. So it must provide more forward-looking information. So now there's a lot of research related to forward-looking disclosure, where the company actually disclose more future prospective information based on the historical performance. So the disclosure needs to be more forward-looking information. So when the user are making these decisions about what they want, whether they want to invest or they want to give credits, um, it is important to actually estimate whether this company is in a good situation or not, because they need uh, to be able to uh, settle their obligation, yeah, to be able to generate future cash flow. For instance, if for investor, they want their return, yeah, they want the dividend. So they want to know whether this company can pay the dividend. Or for uh, the creditors will need information whether the company can pay back their loan, yeah, their liabilities. So it is important, becoming very important, whether the disclosure is actually meets the forward-looking information. And there's a research on that, looking at how important the forward-looking disclosure, and then focus more on the factors that create longer term value, including non-financial measures. So now it is becoming important, like how the corporate governance are affecting the way the company are um, running, and this is also related to the reporting. So controlling the managers, yeah. So the committee, the audit committee, the commissioners, they have a function in monitoring and controlling the management in how they actually creating or making their reporting based on their future or longer term value. So it is very important at that some point. And then it's better align information reported externally with the information reported internally. So sometimes what they report to the external is different to what is happening internally. So we don't want that. We don't want that happens, because that can lead to earnings management, can lead to fraud, can lead to asymmetry information, and it's become a huge impact on the performance of the company. So example like Enron case, or example like in Indonesia, the Garuda company case in Indonesia, where they actually did not disclose properly. They did not disclose, it's not aligned between the information that they give to the external with the information that they actually are having in internally, or what's going on internally. It's not aligned with the information that they give to the external parties. So it is very important at that some point. Disclosure are very important for companies to actually disclose in a proper way and in a complying way. And there are some issues related to how disclosure are being differential, because IASB also developed IFRS for small and medium-sized entities, or SMEs. And I think you're gonna have a class specific related to standards, accounting standards for SMEs. And in Indonesia, we are adopting this IFRS, and because we know that now companies that are surviving in this pandemic COVID are more usually the SMEs, and they have a big contribution, yeah, for the rising of the economic conditions. So SME become important entities, but cannot they cannot comply with such a complex disclosure requirement if they have to follow the IFRS. So IASB, they develop, yeah, for IFRS for specific for small and medium sized, and it is a less complex in a number of ways. So first, the topics are not relevant for SMEs are omitted, such as related to earnings per shares, because SME they don't issue shares, yeah, they don't issue shares. So related to derivatives, they don't need that. They don't need to comply on having information related to share price, and allow fewer accounting policy choices. So For example, related to depreciation for intangible, amortization for intangible assets, and other inventories related, that becomes there's many choices. So for the SMEs, it will be more straightforward. It will be more less choices, yeah, for them to actually choose which one is more fit or is more applicable for the SMEs. So they give fewer accounting policy choices. And many principles for recognizing and measuring assets, liabilities, revenue, and expenses are simplified. So it's more simpler, yeah, for SMEs to actually make their financial reporting. But they still need to comply with the standards or the rules that the IFRS for SMEs are putting, making this a useful information for both the preparers and also the users. But principles for like recognizing like deferred tax, deferred liabilities, and measuring asset like impairment, like revaluation of an asset, they make that more simple. So it's not applicable for the SMEs. Uh, at this point, it becomes different for big companies, like company that has already go publics, or company that's issuing shares for the investors. They need more complex standards, yeah, rather than the SMEs, making it simplified. And significantly fewer disclosure are required. So this is an impact from the fewer accounting choices and the topics not relevant to SMEs. So it becomes only fewer disclosure are required. And then there's a revision for the IFRS for SMEs will be limited to once every 3 years. So not like the regular, the IFRS for public companies, they update it every time, they update it every years, or even more than once in a year. So I know that the IASB, they have so many meetings talking about just how revenue recognition, how related to leasing, pensions. So it's then impacted on how companies are actually complying with the standards. So then the notes to the financial statements, notes are the means of amplifying or explaining the items presented in the main body of the statements. So it is very important that the notes the company are writing are able to explain and give more information, give more explanation, give more insight on the numbers on the financial statements. Because for instance, we have the inventory numbers. Yeah, we have the inventory numbers in the financial statements, yeah, in the asset, but we don't know whether that inventory numbers are calculated using what type of method, yeah, because users need to make comparison. Yeah, users need to compare whether the inventories or the asset are can be compared with the other companies, with the previous years, or within the industry. And when we compare something, we don't want to compare numbers that is generated with different method. we want to compare numbers that is actually using the same method to generate that number. So it is very important at that point when notes are giving a more explanation related to the numbers of the financial statements. And then accounting policies. So companies should present a statement identifying the accounting policy that they are adopting. So company must identify judgments, made in the process of applying the accounting policy. So professional judgments that they are using, they need to also needs to write it down. Why that accounting policies are being applied to the company, and disclose information about assumption made. Now that's also very important. Assumptions can mislead information if it's not properly informed for the users, because assumptions are only known by them internally. Externally, this assumption needs to be disclosed properly. And there are major disclosures that's related to the common notes, or at least these major disclosure are given attention more or more attention for the users when they are reading the financial statements, and we are there reading their disclosures, and make sure that these common notes are there for the users to read, for the users to analyze, and therefore they not giving a wrong decision making, making sure that the information they receive will lead to a better information, a quality information, so that the decision making it's also correct. The decision making becomes very important in the strategic of a company. So this is a common notes like inventory. So like the how companies are uh, recording the inventory based on what method, on what accounting policies, like first in, first out, or like using the weighted average. And there's a lot of choices, in disclosing the inventory. And also the property, plant and equipment, PPE. You have also options for instance, whether you want to revalue your asset, or intangible asset. You want to make sure the impairment, whether there is an impairment or not. We also needs to be able to know that, and what are the steps that the company are making if there is an impairment. So like the loss of impairment, and then whether they want to reverse the loss of impairment, and so on. And then there's creditor claims. Claims becomes an information that is important for the users to understand, for them to make a decision. Contingencies and commitments, fair values information, deferred taxes, pensions and leases. So all of these are very important to actually are disclosed properly. And changes in accounting principles become also important, because we cannot compare from previous years. If there is a changes in accounting, the users cannot see that if they are not being informed. Okay, Azan. And there is disclosure issues. There's issues in disclosure. This point, there are disclosure for special transaction or events. And at this, we need to understand whether the transaction is related party transactions, and what we need to disclose is the nature of relationship, the amount of transaction, the provision, the expense during the transaction or the events. So all of this needs to be written down, yeah, to be able to explain the transactions, specific transaction are being made. Okay, and move again to disclosure issues. This relates to events or subsequent events, events that are actually after the statement of financial position date. So after the 31st of December, that's usually what we call subsequent events. So this is the financial statement period, and this is the subsequent events. So there are some transactions can actually impact on the financial statement numbers, and this influences the financial statements. Okay, just wait for the azan first. Waiting for azan. Okay, we continue. So the events after the reporting period becomes very important for the company to make sure that all the information that happened after the financial reporting period needs to be disclosed also. Okay, let me go. So there is events that provide additional evidence, yeah, that existed at the statement of financial position. For example, like when company decide to refinance their liabilities, or they receive an income or revenue that is being deferred, or interest payment or tax deferred, that's actually have influence, yeah, in this subsequent event period. So this become also an issues, yeah, in how they will disclose it in the disclosure. And another disclosure issue is related to companies that actually has many diversification product, or they have a diversity product or diversified companies. For example, there are companies not only one segment product, or they're not just giving service to one product, but they actually giving service to a different product. Yeah. For instance, like this is a company that actually selling office equipment, but on the other hand, they are also selling automotive parts. So investors and investment analysts want income statement, statement of financial position, and cash flow information on individual segments. So then we know there are segment reporting, there are segment disclosure that are apply to some company when they have so many diversification in their companies. So, and that can also relate it to the diversity of the product or the diversity of the geographic area that they are operating in, and making the numbers that actually in the financial statements, when they usually make it as an aggregate numbers, or they accumulating the numbers. And so the investors or the analysts, they want to know each segment. They want to know the individual performance of each of the segment performance. So we have the consolidated, but then we have the each segment, the individual segment disclosure. So this can also become very expensive for company to actually make this reporting, because it becomes more rigid, it becomes more details and difficult if the company are not supported with IT or information technology. It will become so difficult, yeah, in making the individual segments reporting or disclosure. So then it is very important, and now there are a lot of research also on segments disclosure or segments reporting are affecting the firm value, or the how the share price, or how the reaction of the investors, or even what factors actually affecting these segments. Yeah. In producing these individual segments, there are maybe difficulties on the company side, on the preparer side. And that's why there are issues in this disclosure for reporting segmented information. And actually, we have to understand, yeah, the objective, why company needs to make reporting segmented information or segments reporting, because they need to provide information about the different types of business activities. This is generate because they have diversification. Yeah, they have a diversity product. They make their strategy in growing their companies, yeah, by making the product more diversified. So they become different types of business activities, and this needs to be individually reported or separately, yeah, in which an enterprise engage and the different economic environments in which it operates. So this can actually meet the object. This objective will help users, yeah, the users, the investors, the creditors, the regulators, yeah, in better understand the enterprise performance. Because if the company, if the enterprise is not disclosing individual segment, it's going to be hard to analyze, yeah, the whole lot, yeah, the consolidated, the cumulative numbers, the aggregate numbers. So they need to have segmented information. And then it better assess its prospect for future net cash flows, yeah, and make more informed judgments about the enterprise as a whole. So it's become very, very important when we look at how the companies in each of the business activities are being reported. And then there are also issues related to the basic principles that the IFRS are requires the general purpose of financial statements, yeah, include the selected information on a single basis of segmentation, and the company must meet, yeah, the segmented reporting objective by providing segmented based on how the company's operation are managed. So in a management approach. So this actually become a big issues if the management or the company are not ready in supporting to generate or to provide this segmented information. And then the identifying operating segment. So an operating segment is a component of an enterprise that engage in business activity. So the individual operating segment is actually related to different each of business activities from which it earns revenues and incurs expenses. So these activities is actually based on when the company generate the revenue from. Yeah, if that different type of operating give different revenues, give contribution, yeah, different contribution to the total revenues that the company are generating. So they need to know that who contributes more, which product are more profitable, which product are um, experiencing losses. So it is important when these reporting segments disclosure are related to the business activities. And then whose operating results are regularly reviewed by the company's chief operating decision maker. So this operating also needs to be reviewed, yeah, reviewed by the chief, the CEO for the decision maker. And then for which discrete financial information is available. So this is very important. And when we want to identify the operating segment, so how we know, yeah, how we know or how we report, yeah, the operating segments. This is become significant, and therefore it is become a reportable segment if, yeah, if it satisfies, yeah, meaning that when do we know company has to make a reportable segment? They have to make a reportable segment if it satisfies one or more of the following quantitative threshold. So there are a minimum requirement when their minimum requirement if they want to, or they have to comply with a reportable segment. First, if its revenue is 10% or more of the combined revenue of all the company's operating segments. So that segment, yeah, the A segment, for instance, company has A, B, C, D segments. For A segment, if that A segment is generating 10% or more revenue, meaning that they have to make their individual segment report. 2, if the absolute amount of its profit or loss. So first it's the revenue. Now it's the profit or loss. Yeah, is 10% or more of the greater in absolute amount of the combined operating profit of all operating segments that did not incur a loss. The combined loss of all operating segments that did not report a loss. So it is important we know which to report, yeah, which segment and that are mandatory to be reported. Its identifiable assets are 10% or more of the combined asset of all operating segments. So there are minimum requirements, yeah, to be able to be applicable for the information or the reporting segmentation. And in identifying operating segments, in applying this test, the company must consider 2 additional factors. The first one is segment data must explain a significant portion of the company's business, meaning that this segment data has influence, a high influence on the business. Specifically, the segmented result must equal or exceed 75% of the combined sales to unaffiliated customers for the entire company. The IASB decided that 10 is a reasonable upper limit for the number of segments that a company must disclose. So it is not easy, yeah, to make a segmentation information or disclosure. So we can see here, this is segments A, B, C, D, E, and F, for example, and this is all the total revenue. You can see the total, the aggregate or the accumulation, and then this is the operating profit and loss, and this is the identifiable asset. So we have these 3 to actually analyze, yeah, evaluate, yeah, whether they need to make a segment report, whether they meet or satisfies, yeah, the requirement that I've just mentioned. So here are the total revenue, the operating profit loss, and the identifiable asset. So here we can see, we can identify it. Let's see, this is an example. Let's share slideshows. Okay. Yeah, so you can see here 10%, yeah, from 2,150 is 215. So which segments meet the segmented report? So at this point, more than 215 is C, D, and E. A, B, and F does not mean the requirement. And also, so they don't meet the requirement of segmented reporting, yeah, segmented information. And then for the operating profit and loss, the 10% is €9, from 10% is 9. So the one that if they're using the profit or loss percentage, the segment that needs to required to make the segmented information is A, C, D, and E. You can see it more than 10% of the total profit and loss. Okay, and also the identifiable asset, 10%. You can see the one that meets C, D, and E. So therefore, assuming that A, C, D, and E, assuming that these 4 segments have enough sales to meet the 75% of combined sales tax. So the 75% is actually 1,612,050. Is it correct? 1,612.50. So this is the total combined sales test. So it has to be 75%. So A, C, D, and E meet the requirement. Yeah. And then, so that's the segmented reporting. How about the issues on measurement principles? And this is also an issues in the disclosure area related to measurement principles, like the accounting principles that companies use for the segment disclosure is not the same as the principle they use to prepare the consolidated statements, because they have their own principles, yeah, as the print they use to prepare the consolidated. So they have the individual segments report. The IASB does not require allocation of joint, common, or company-wide costs solely for external reporting purpose. Common costs are those incurred for the benefit or than one segment and whose interrelated nature prevents a completely objective division of cost among segments. So this is very important related to the measurement. And then we have still in segmented information reporting, IASB also requires the following related to the segmented information. So this segment disclosure is also a good research to do because there's a lot of going on here. And here IASB requires enterprise report the following if they use a segmented information. First, the general information about the operating segments, to the segment profit and loss and related information, segment assets and liabilities, reconciliation, information about products and services, and geographic areas. As I mentioned, geographic areas also become important in when the company needs to make a segmentation reporting. And also this relate to the major customers. Okay. Interim reports, that's also a disclosure issues because now company wants timely information, updates information that's for the users to read or to become more current information are available for them. So cover periods less than 1 year. So interim reports covers more frequent information, yeah. And companies to follow the discrete approach treat each interim period as a separate accounting period. Oh, that's become more difficult, yeah, for companies when they have to treat it as a separate accounting period. Follow the principle for deferrals and accruals used for annual reports. Report accounting transaction as they occur, and expense recognition should not change with the period of time covered. So there's an uh, important policies that the companies needs to be aware when they want to make the interim reports. Okay, and unique problems for interim report like income taxes, seasonality, yeah. And then auditors and management reports. This is also one to make that full disclosures because uh, we know that auditors' reports are the reflectings and the opinion when they verified, the auditors are already verifying the numbers, yeah, based on the evidence, based on the realities, based on the performance. So last but not least, this is the auditor's report. No, I don't want to go through that. But related to current reporting issues, there's a separate between financial forecast and financial projections. Yeah. There is a forecast is a set of prospective financial statements that present a company's expected financial position, results of operation and cash flow. So, and then financial projection is actually a prospective financial statement that present given one or more hypothetical assumptions. So there's assumption in or estimations, judgments that the company make for expected financial position, results of operation. So this is more projections based on uh, the assumption or judgment. And there's this internet financial reporting that makes firms communicate more easily and quickly with users, allow users to take advantages of the tools that they have in the internet reporting, yeah, and they can give more relevant information. So last, this one will actually lead to my next session related to fraud, financial reporting, because we know fraud in financial reporting, this also related to how they disclose, yeah, the making the disclosure. So there is, this is based on a research related to type of economic crime. Yeah, so they make asset misappropriation. You can see here there is so many. There's a percentage of fraud because of asset misappropriation, and then the cyber crime, bribery and corruption, procurement fraud, accounting fraud, human resource fraud. So there are issues, fraud in financial reporting that we need to be aware of at this point. Okay, I think that's from me. We still have we have some times maybe for Q&A before 12:30. Okay, so I'll give it back to the moderators. Thank you. The moderator.
Okay, thank you, Miss. So maybe we gonna next to the next agenda that is a Q&A session. Does anyone have a question about this class, guys?
Or maybe everyone already understands related to disclosures. And hopefully for the next session, I will be talking more on reporting specific to sustainability and then related to fraud and quality reporting. And hopefully in that there is some issues that we can look at for the extension of this disclosure, the issues, and then we can relate it to the corporate governance when there are control or monitors function from the corporate governance when the company are making their disclosure, when they're making reporting. It is very important part of that to generate the quality reporting or quality information with the help of the audit committee, with the board of commissioners. So that's part of the corporate governance there. Okay, I think if there's no question, I would like to close with Hamdallah. Alhamdulillah. Assalamualaikum warahmatullahi wabarakatuh. But if there's still question, you can actually write it down and I will help in answering. So maybe the question are not now because I still have another 2 session, I think, but moderator. So if if the participant of the summer school wants to ask questions, I will be happy to answer, yeah, in my next session. So maybe we can write it down, the questions, and give it to the moderator. I think that's from me. Thank you.
Okay, thank you, Miss. So guys, before that, I would like to document this meeting. Can you open your camera, guys?
Okay. Assalamu alaikum.
Waalaikumsalam.
Waalaikumsalam.
Thank you, Doctor, for this beneficial lecture. Actually, very interesting, and it has a lot of beneficial information about disclosure and corporate governance. But I would like, if you can, Doctor, link between disclosure and earnings management, because you know earnings management also affect the quality of financial report, and the managers have their discretion to manipulate or modify the items of financial reports to improve the ROA or ROE or something like that. So is there any relation between earnings management as a practice of manipulation and disclosure, or disclosure can minimize the behavior of managers in practicing earnings management, both real and accrued earnings management? Thank you, Prof. This is my question.
Thank you, Dr. Ali. Nice to meet you. Yeah. So, Dr. Ali, yes, certainly. We know that between the users and the preparers, there's certainly will have an asymmetry information. I think this is because of the information that they have between the preparers, the company side, and the users, the readers of the information are asymmetry. So at this point, if we want, well, this is from the, say they are, they behave well. Say for instance, they want to manage the earnings, but in a positive way. At this point, if they disclose it properly, or they disclose it in in a way they are complying with the standards, that become a benefits for the readers and also the users. But sometimes, because we know that there are so many choices in accounting policies, so many judgments, so many assumptions, so many that also can lead to earnings manipulation. That's why what I mentioned, that there's so many fraud, there's so many behavior that can lead to earnings management, and even with so extensive disclosure, if they are behaving in a purpose or in a intention to manipulate their numbers, in manipulating their incomes, or at the end of the day, say like Enron, we know that big huge companies, they have very good reporting system. They have good shares price at that point, but and then it comes to how they report their numbers, how they put their numbers, where at that point there are so many manipulation. There are not what we can say, they are not giving their true picture of their performance. So I think that's impacted on their auditors as well at that point. So in Indonesia, we have the case of Garuda. Garuda also has problems in their reporting. So when they actually have, there's a earnings management there. So at some point, yes, I think the relationship between disclosure and earnings management is very related, because we know that if we want to know whether there's earnings management, we can actually test by looking at the accruals numbers, discretionary accruals numbers, and even disclosure minimize that asymmetry information. But still, there's still chances having the earnings management. So that's why actually it will be good if we actually relate it to like the corporate governance, or the monitoring or controls, the internal control in the companies that actually can avoid or give a control in the behavior of the managers, the behavior for not doing the earnings management. I think that's my
Thank
suggestion.
you, Doctor. Thank you, Doctor.
Carl.
I think lack of disclosure, I think, leads to earnings management, or the managers or the management intention to behave earnings management and give lack disclosure, or low disclosure, because maybe disclosure will uncover the practices of their behaviors, or of earnings management. So I think lack disclosure or disclosure goes in the same line of earnings management.
Yes,
The high
that's
level
right.
of earnings management maybe leads to lack of disclosure or something like that. Thank you, Doctor,
Yes,
for
that's right. Thank you.
beneficial information of this lecture.
Yes.
And thank you
Yes.
for your response.
Thank you, Dr. Ali. It is an issue where now company has to make so many because of the so many standards. I think the IFRS are making a lot of standards. There's another issue between the cost they want to comply with all the disclosure. But on the other hand, you are right. If there is lack of disclosure, there will be a chance of earnings management. So what there are some research on whether to focus on the benefit of disclosure and the cost versus the cost of the disclosure. I think nowadays, because IASB are they issuing so many IFRS standards where company needs to comply. So, but the other hand, the readers need all the information. Yes, I think that's a point there. Thank you so much.
Also, I think, Doctor, in the countries that have political instability,
Yes.
also we can see the issues of disclosure and earnings management very high, and there is a lack of disclosure to cover the bad performance or financial performance because they working under political instability, such as Palestine. We are suffering from many issues, many lack of maybe good governance or not a lack of good governance. Our code of corporate governance have not reviewed since 2008 and 9. When my thesis in Ph.D. was I moderate the political instability, and I find that during political instability periods, managers or companies practice high level of earnings management, both negative or positive earnings management, and also there is a lack of disclosure about something, some items in or some practices in financial reports. But Alhamdulillah, now I think our corporate governance, I think, is going to be developed and more strict. Also, in our banks and insurance companies, I mean financial sector, we have a strict focus in these companies because these companies, financial companies, affect the economic more than other companies like industrial or service companies, because Palestinian economic depend on financial sector more than other sectors. So they have a strict and more developed corporate governance, and they must disclose about all their actions during the year. Alhamdulillah, thank you.
Thank you. Thank you, Dr. Ali.
This is
Thank
a brief about
Yes, thank you so much.
Palestinian economy or something like
Okay, thank you, Mr. Ali, for the question. Maybe we can next to the
Terima
next.
kasih.
Kasih.
Terima kasih for all.
Next to the next agenda is documentation. Can you guys open your camera, guys? Okay, maybe I will capture this meeting in 1, 2, 3. Okay, so for the second slide, 1, 2, 3. Okay, so this is the end of our class. Thank you so much for Miss Effie. And you guys may leave this meeting. Thank you. Thank you, Miss.
Thank you very much, everyone.
Thank you.
Assalamualaikum.
Thank you for all.
Thank you, sir.